Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler talking money and investing. So, how you doing versus everybody else? Doesn't everybody love that? I find people get into comparative analysis all the time, and it can be pretty destructive stuff. As if I'm comparing myself to somebody else, and it's so often I'll have conversations with people, and they'll say, "Oh, I just feel terrible about where I am and what I'm doing," and then I'll just say, don't compare yourself to somebody else. That's a bad angle to go at life, because there's always going to be somebody doing better than you. There's always going to be somebody doing worse than you. And the reality of it is you have gifts and talents that are going to be totally different from somebody else's. And quite often those gifts and talents, your friends covet yours. Quite frankly, we don't even necessarily think about that. A lot of times other people will go, "Man, I wish I could do what you do." And I often find that people don't necessarily give themselves enough credit. I have found often when I'm talking to people, they'll say, "Well, everybody can do what I do." And I'm like, "No." I'll raise my hand and go, "No, I can't even come close to doing the stuff that you do." But we do compare ourselves to other people when it comes to finances a lot. And this article does exactly that. Think your retirement savings are enough? Here's the average 401k for people in their 60s. So they're looking at what's the average balance. Now, this right off the bat is problematic, because you look at averages. When you're doing statistics, we don't necessarily like looking at the average or the mean of a statistic, because what happens is it gets skewed, because you'll have people with unbelievably huge balances and it skews that number upwards. So the average 401k balance, as they said here, for somebody in their 60s was $568,000 as of June of 2025. Now, if you go and dig a little bit deeper and you look at the median, this is typically what we look at when it comes to statistics, is the median. Half people are above you, half people are below you. It gives you a little bit better idea of where you are compared to everybody else. And this isn't necessarily a good thing. Like I said, I'm not big on comparisons, but it's $188,000. So how much income can I take off of that? If you look at it, let's say if it's just a nice round $200,000 and you use the 4% rule, that's only $8,000 of income per year. So you look at it and go, wow, a lot of people are going to be struggling when it comes to retirement if that's all they've saved. Because Social Security is only designed, it was only set up to replace like 40% of your income in retirement. 40%. So, whatever your income is, 40% is about it, because the way it works is you'll have a little bit of income. Your historical income is replaced at 90%. About $12,000 of income is replaced at 90%. So if you never made more than $12,000, that was all your income was in today's dollars, all through all of history. Well, if you never had any more income than that, you're probably going to be fine in retirement on just Social Security, because 90% of your income is going to be replaced. And then you got 32% of your income. So what happens is with Social Security, you'll have income that is replaced at different breakpoints. And then you'll have a lot of your income's only replaced at 15%. So if you're a high income person, your replacement of income is going to be super, super low. So that's why you'll hear the rule of thumb, 40% of your income in retirement is going to be Social Security. Well, if I don't have a pension, and a lot of people don't have pensions, a lot of people that have pensions have gone bye-bye. Nobody does them anymore because it's too expensive for companies, especially companies that are actually competing with other companies around the world. They can't afford to do pensions anymore. Now, governments still have them, and governments typically have the best ones out there because they actually have COLAs on them, cost of living allowance riders on them. But, that's not the norm. Most people don't yet actually have that. They have their 401ks. And if all they've got in their 401k is a couple $100,000, and now you have Social Security, and then you have another $8,000 of income coming from your retirement accounts, it makes for a really difficult retirement. So the question is, well, what do you do? How do you protect yourself? What can you do to protect yourself and get more money in your 401k? And, they talked about making catch-up contributions. Well, I mean, that's well and fine. For 2025, the limit that you can put in a 401k is $23,500. Well, if you were putting that much money away, you probably aren't one of these people that doesn't have any money saved for retirement. So a catch-up contribution is not going to be that big of a help, which is where you can put up another $11,250 into the plan. So you got the $23,500 plus $11,250, and you can put $34,000 away. If you're putting that much money away, you're probably not one of these people that's struggling. So I'm just going to skip over that particular piece of advice right there. Reallocate the assets. Now, maybe not a bad idea. A lot of people don't actually have very good asset allocation in their 401k plan. Asset allocation is how do I divide between stocks, bonds, cash, fixed income investments, but further, how do I divide between large companies and small companies? How am I divided between value companies versus growth companies? How am I divided between international versus U.S. stocks? Asset allocation drives between 91 and 94% of your performance of your portfolio. It is the single most important thing that you can be focusing on as an investor. But what do most people focus on? It's not that. They typically focus on which companies, which stocks. Well, when they looked at the Brinson Hood Biebauer studies and the various studies that have been done on what drives investor performance, when they looked at it, what they actually found is when people engaged in the process of figuring out which companies were better than others, only about 4% of investment performance was due to that. 4% or less. So it's not something that we ought to be focusing on. Don't sit there and wring your hands at which company is going to be the winner in the AI race or the winner in the next, over the next coming years as far as, technology companies or next companies that are going to be doing really, really well in services or next companies that are going to be the next great retailer, the next great, whatever. Don't look at that. That's not important. All companies, if we look at all companies that want to use your money, they are all going to have to pay to use your money. Now, some of those companies are going to go under, and they won't end up paying anything to use your money because they went under. But that's not their goal. All companies have to pay to use your money. To bet on specific companies having to pay more to use your money is probably not a great bet to make. Now, which areas of the market to be in? Should I be leaning a little bit more growth right now? Should I be leaning a little bit more value? Should I be leaning a little bit more international or U.S.? Or where should I be leaning? Should I be leaning more toward bonds? That's tactical asset allocation. Well, that only about 1% to 2% of return differences were explained by that. And again, when pension plans focused on that, they hurt returns. They didn't help returns. So reallocating assets and going, this is really what I ought to be spending my time on. Which areas of the market, what segments, and what mixes. I agree with that one. That's dead on. That's good. That's really good, making sure. Now, how do you allocate assets in general? Typically when I have a longer time horizon, more in equities, more stocks. 75, 95% stocks. It's not unusual to see that level of stock holding in a portfolio where somebody's not going to retire for at least 10 years. Having mainly stocks because our main thing is this, protecting ourselves against inflation. And inflation is prices going up, and who's raising prices but the companies that we own. So that's why stocks have historically protected us from inflation. So yeah, we want to focus on that. If I'm getting nearer to retirement, I may be less than 75% stocks. I might be getting down closer to 60% stocks or somewhere in that neighborhood. Typically even in retirement, when you're taking an income off of a portfolio, the research is pretty clear, not less than 50% of your portfolio in stocks. Now, we're not talking about your emergency fund, which might be all cash. We're talking about your stock portfolio or your investment portfolio, I should say, that you're going to draw income off of. 50, and I've seen people of 75%, and they're okay with that. It just depends on the person. I see some people that are like, I'm not really dependent on my portfolio. I've seen they'll hold even more stocks than that. But I'm talking about the person that's trying to live off of the portfolio. That's where those numbers come from. Consider downsizing now is another thing to look at. Well, when we're downsizing, we're talking maybe your house is a lot bigger. Your kids have moved out. You don't need as much space. And it might not be a bad idea to downsize, take the money that you gain because you buy a cheaper house and invest more and maybe max out the 401k, maybe live off of some of that money and defer all of your paycheck into the 401k or most of your paycheck into the 401k. So that, well, maybe not quite. It might not make total tax sense to do that unless you're using like Roth combination. If you're really, you got to look at the differential between your marginal tax rate right now, and that's not really where I wanted to go in this segment, but you got to look at maybe deferring more of your income for the future, whether it be through a 401k, non-qualified accounts or something like that. But there are things that you can do now if you have downsized and you've freed up some money to actually invest for the future. And they talk about working with an advisor. Because a lot of times what happens, it's like working with a personal trainer. I find that some people just don't have a lot of discipline going to the gym and working out. It's not their thing. But if they have somebody that's pushing them a little bit, hey, do another 3 pull-ups or something like that, or hey, you got up to 10 curls here. Let's see if you can get 3 more. Try to do a little bit more than you're necessarily going to drive yourself to do. And that's a lot of times what the advisor does, just kind of push you to do a little bit more. Maybe get you to think about things you wouldn't necessarily think about. There may be things that are from an efficiency standpoint might be helpful. Hey, you ought to do a Roth IRA or do that versus a pre-tax. Or maybe you ought to work a couple more years because it'll increase your Social Security benefits. Maybe you'll change the order that you take Social Security. Maybe, the spouse that has a much lower income history will take their Social Security first and you take yours later. Defer it to a little bit later in the future. So there are things that they may come up with that you don't even think about. I always tell people, you don't know what you don't know. And that's why it's important. But anyway, I think that's decent advice, but I was kind of surprised by the numbers in this particular article on how much money people have saved for retirement because there may be things that they need to do to get going a little bit more. If you're one of those people that's a little bit behind, don't give up hope. Maybe you've gone through a divorce. Maybe you've gone through rough times. Recognize that there are typically things you can do that you didn't even recognize that you could do. And that is why I think it's important to actually get working on it earlier than later, because every 7 years you wait to prepare for retirement, as I often say, historically based on market returns, you cut your retirement in half. Waiting is not a great idea. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. paulwinkler.com is the website where we have lots more there. We have a workshop coming up on Medicare, not too far out into the future, because it's getting to that season again where you're going to see a ton of commercials on Medicare supplements, and you're going to be wondering, what on earth do I do? And quite often, what people do is they just rely on an agent selling products, and some of them are great. Some of the agents are just fine. But sometimes maybe you're not getting the best information. And I'm going to tell you, you're typically not getting great information from the commercials. Because often those commercials on Medicare programs out there, the Part C programs and things like that, are just not necessarily all that accurate as far as what you might expect in the future. So you got to be really, really conscious of that type of thing. So we're going to do a workshop. I think we've got again this year. The people from SHIP are going to be coming on. State of Tennessee, the health insurance, they have a group that actually helps people make decisions on this by providing information that's non-biased. And I will often, in the past couple of years, I've actually used them for this particular workshop because we don't have a dog in the fight. When it comes to giving any kind of information on these types of things, we're not selling anything. So you don't have to sit there and go, I wonder what their bias is here. It isn't. We don't have that. So you might want to check that out. Go to paulwinkler.com, and you can sign up for, I think it's out there. I think it's already out there that you can sign up for that. I might be speaking out of turn. I'll check that out. But that's going to be coming up, I think, in the first part of October. I think is when I'm going to be teaching that workshop with those folks. Article talking about the direction of interest rates. And, where are we going with interest rates? And it was interesting because they had this whole thing about the reduction in short-term interest rates may actually coincide with an increase in long-term rates. Where have you heard that before? Me. I have talked about that a lot. I've been saying, hey, you know what? You may be thinking, hey, if we could just reduce interest rates, we could have lower long-term interest rates. The mortgage market would take off. The housing market would take off. This would be a great thing. Not so fast. And they says, take with a grain of salt any investment advice based on pronouncements on where interest rates are going to be in the future. And it just harkens back to something I've talked about here on the show before, where you had that study of economists, and it was like 60 or 70% economists, and they said, where are interest rates going? And these are people that are smart. These people that spend a lot of time in school, graduate economics courses. Where are things going to go? And 60 to 70% of the time, they were wrong on the direction. It's a 50-50 shot. Are they going up? Are they going down? 60 to 70% of the time, they were wrong. You can't depend on these people, their ability to tell where things are going to go. You just can't. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.